Welcome to Agentiver Academy, where we believe smart investing isn't just about making money, it's about building a secure, stable future for yourself and your community. Today, we're diving into some timeless investment strategies that can transform your financial journey. So, whether you're just starting out or looking to fine-tune your approach, this is for you. Transition to long-term thinking. Let's start with a question. Have you ever felt anxious watching the stock market rise and fall? It's natural, but the key lesson here is to think long-term. Benjamin Graham and Peter Lynch, two investing legends, both emphasize this point. They teach us that reacting impulsively to short-term market fluctuations can lead to mistakes, like selling too soon or buying at the wrong time. Think back to 2008 during the financial crisis. Many investors panicked, selling off stocks at a loss, fearing the market would never recover. But those who stuck with it, who had a long-term vision, and held onto fundamentally strong stocks, saw their portfolios not only recover but grow significantly over time. Here's a way to think about it. Imagine planting a tree. You don't keep digging it up every time the weather changes, right? You water it, let it grow, and eventually, it bears fruit. That's what long-term investing does. Focus on the growth, not the weather. Transition to value investing. Now, let's move into value investing. If long-term thinking is about being patient, value investing is about being smart with your patience. This strategy, popularized by Warren Buffett, is all about finding stocks that are trading below their true value. Think about it like shopping for a quality item on sale. You know its worth, but for some reason, the market doesn't. So, you buy it at a discount, and in time, it appreciates. A real-life example of this is Buffett's purchase of Coca-Cola stock back in 1988. At the time, the stock was undervalued in his view. Fast forward, and that investment has paid off immensely. So, next time you're thinking about buying a stock, ask yourself, is this stock on sale for reasons that don't reflect its true value? If yes, you might be onto something great. Transition to emotional discipline. Now, let's get real about something that affects every investor: emotions. Have you ever made an investment decision based on fear or excitement? It's easier than you think to let emotions cloud your judgment. In The Psychology of Money, Morgan Housel explains how fear, greed, and impatience can lead to bad decisions. Remember the dot-com bubble? Investors, driven by fear of missing out, jumped into tech stocks without considering whether those companies were actually sound investments. The market crashed, and a lot of people lost money. The takeaway here: you need emotional discipline. Picture it like driving a car in a storm. The road gets bumpy, but do you slam on the brakes? No, you stay steady, keep your hands on the wheel, and stay focused on the destination. When the market gets rocky, stay calm, stick to your strategy, and don't let fear or greed dictate your moves. Transition to diversification. Another key to investing success is managing risk. And that's where diversification comes in. Think of it like building a strong, balanced meal. Just as you wouldn't rely on one food group for all your nutrition, you shouldn't rely on one type of stock for all your returns. During the COVID-19 pandemic, industries like travel and hospitality took huge hits, while sectors like technology and healthcare thrived. Investors who had a diversified portfolio spread across multiple industries were able to weather the storm much better than those who were heavily invested in just one area. So, when you're thinking about your investments, ask yourself, if one sector takes a hit, do I have others that will hold up? Spreading your risk across industries and asset classes protects your overall portfolio from major shocks. Transition to simplicity and low-cost strategies. Let's talk about simplicity. Sometimes, in the quest to outsmart the market, we forget that simple strategies often work best. One of the simplest, yet most effective strategies: low-cost index funds. John Bogle, the founder of Vanguard, popularized this idea. An index fund tracks the market, allowing you to benefit from broad market growth without high fees or complex strategies. Think of it as riding the wave of the entire market instead of trying to catch individual waves that might crash. For example, let's say you invest in an S&P 500 index fund. This fund gives you exposure to 500 of the largest companies in the US, allowing you to enjoy the general upward trend of the market. You don't have to worry about picking the right stock, just sit back and let the market work for you. And here's the magic of compounding. The longer you stay invested and reinvest your earnings, the bigger your returns grow. It's the snowball effect, what starts small gains momentum and becomes something much bigger over time. Transition to investing in what you know. Let me ask you this, have you ever thought about investing in what you already know? Peter Lynch believed that some of the best investment opportunities are right under our noses. His advice: invest in industries and products you understand. If you work in tech, for instance, you probably have insights into which companies are innovating and which ones aren't. Use that knowledge to guide your investments. Lynch himself invested in companies he was familiar with and believed in, and that approach brought him massive success. So, next time you're thinking about a stock, consider this: how well do you understand the company and the industry it operates in? Sometimes, your personal knowledge can be your greatest investment tool. Transition to consistency. Here's another key to success: consistency. Building wealth isn't about hitting a home run with one investment, it's about showing up regularly, contributing steadily, and sticking to your plan. In The Millionaire Next Door, we learned that most millionaires didn't get there through flashy investments. They got there through disciplined saving and investing over time. For example, if you set aside $500 a month into a diversified portfolio, that investment can grow significantly over the years, thanks to the power of compounding. Think of it like training for a marathon. You don't go out and run 26 miles on day one. You build up gradually, consistently improving, and over time, you reach your goal. Transition to building assets for financial independence. Now, let's talk about the ultimate goal: financial independence. This means building assets that generate income for you whether or not you're actively working. Rich Dad Poor Dad by Robert Kiyosaki emphasizes the importance of accumulating assets that work for you. Imagine owning a rental property. While you sleep, your tenants are paying rent, building your wealth. Or consider dividend-paying stocks, which provide a regular stream of income you can reinvest. Over time, these assets allow you to generate enough passive income to cover your living expenses, freeing you from relying on a paycheck. So, ask yourself, what assets am I building that can provide for me in the future? Financial independence is about creating income streams that work for you, long after you've stopped working for them. Transition to market efficiency and index funds. Lastly, let's talk about one of the most straightforward strategies: index investing. Burton Malkiel's A Random Walk Down Wall Street reminds us that the stock market is largely efficient, meaning it's tough to consistently beat the market through individual stock picking. That's why index funds, which give you exposure to the entire market, are so effective. You don't need to outsmart the market. Instead, you invest in it, trust the overall long-term growth, and benefit from the steady rise of broad market indices like the S&P 500. Conclusion: To sum it up, successful investing isn't about luck, it's about discipline, emotional control, and making smart, long-term decisions. Whether you're focusing on value investing, diversification, or sticking with low-cost index funds, these strategies work best when you stay consistent and think long-term. Remember, investing is a journey, not a race. Apply these principles, stay the course, and watch your investments and your financial security grow over time.